Hello everybody and welcome. I am Max from Smart People Finance. This is the place where you can learn how to create new incomes, how to manage and invest your money in the smartest way possible. What I'm going to show you is not a way to get rich quick, but I want to show you the strategies that I've been using for years that can help you reach the financial freedom you're probably looking for, slowly but steadily. So without further ado, let's get into it. If you're watching this presentation, you probably landed on my website, smartpeoplefinance.com, or you found it on my YouTube channel, Smart People Finance. In both cases, you're going to see an options trading crash course, and you are going to learn the basic concepts of buying and selling options. Because trading options is one of the smartest ways to create your wealth, and I'm going to show you why in this presentation. Let's see what you are going to discover in this course. Of course, you are going to understand what options are. Then we are going to see what advantages options can offer to you compared to trading stocks. That way you will definitely understand why you have to start trading options right now. This is a basic course to give you just a general idea on the topic, but then if you want to go deeper and learn the exact strategies that I've been using for years to get a 20-40% return per year, you can have a look at my best course, Selling Option, the Cash Machine course, where I put all my knowledge and that can bring you from zero to hero in less than 1 month. You can find all the details on my website smartpeoplefinance.com. But now let's go on and see what an option is. When you trade an option, you basically trade a contract. This contract has specific characteristics and gives you different rights depending on if you buy or if you sell the contract. From now on, we can say buy or sell the option as they are synonyms. The option contract is basically an agreement between two people and usually is made on stocks, but you can also have index options or currencies options and so on. Nowadays, for example, we also have cryptocurrencies options, just to give you an idea. In this course, we are going to talk only about stock and index options, which are the most popular. Let's see the definition. We have two different definitions for an option contract, as it's different if you buy or if you sell the contract. Let's see both of them. When you buy an option contract, you, in this case you are called the buyer, have the right but not the obligation, remember the right but not the obligation, to buy or sell an underlying asset, so as we said typically a stock or index, at a specific price on or before a specific date. On the other hand, when you sell an option contract, in this case you are called the seller, you have the obligation, so not the right, but this time you have the obligation to buy or sell an underlying asset, again a stock or an index, at a specific price on or before a specific date. Let's continue to see some more interesting definitions. From the previous slide, you have seen that you must learn some terms to better understand what it means. So let's see what they are. First of all, strike price. The strike price is the specific price you have read in the definition and is the price at which the buyer and the seller agree to buy or sell the underlying asset, which usually is the stock or the index I'm interested in. Basically, this is the price at which the stock is going to be bought or sold in case the option is exercised, and you will learn more on this in a while. Now let's continue the definitions. You have also read in the definition before that the buyer and the seller agree to buy or sell the underlying asset at the strike price, and you have just learned the definition, on or before a specific date. But what is it, this specific date? This specific date is called expiration date. And the most important point here is to understand and to learn that options, unlike stocks, have an expiration. That's the big difference. The expiration varies from few days to usually 2 years. On the expiration day, the option is not more tradable and end its life with a final value. This point is extremely important because on or before the expiration date, the option buyer has the right to exercise his or her right, so he can decide on or before the expiration date to buy or sell the underlying asset. Okay? Now, let's see some characteristics. Options have unique characteristics, and it's very important that you know that. First of all, one option contract controls 100 shares of the underlying asset. So, if you're going to exercise your right, you end up buying 100 shares. Okay? So if you buy one contract, you have the right to buy or sell 100 shares of the underlying asset. Then, an option contract has an implicit leverage, so you can earn more money compared to stock. On the other hand, you can lose the entire value of the option, but no more than what you invested. And another good point is that options can be traded with customized strategies that allow you to earn money in any environment. In the bullish, bearish or sideways market, you can always find a solution using options. Now, let's answer another good question. Do options offer more than stocks? The short answer is yes, because they are more capital efficient and are extremely flexible. Let's see some points. First of all, when you buy one option, you control 100 shares of the stock, but you are paying way more less than buying 100 shares of the stock directly in the market. Thanks to this implicit leverage, you can make significant gains with a small amount of money as you leverage your return potential. On the other hand, of course, when trading options, you can lose the entire amount of money you invested in the trade, but never more than that. So basically, it's a predetermined risk, and if used correctly and carefully, trading options can increase your return immensely. Let's see some other points. Another good one is you can trade them in complex strategies. Doing this can help you lowering your risk and make it safer than buying the stock. The best and more important positive factor, in my opinion, trading option is that you can earn money in all market conditions. Yeah, you don't need to be directional. Unlike stock that can make you earn money only in one direction, as stock can go up or down, options can make you money even if the stock price doesn't move at all. That's very, very important, an extremely important point that you have to understand, the big difference between trading stocks and trading options. Now that you have learned the basic definition and seen the advantages that options can offer to you compared to stocks, let's see the two different types of options that we have. So we have call options and put options. When you are the buyer, so you are buying the option, you buy a call option when you buy the right to buy the underlying asset at the strike price on or before the expiration day. Instead, you buy a put option when you buy the right to sell this time the underlying asset at the strike price on or before the expiration day. So basically, when you buy a call option, you are buying the right to buy the underlying asset at the strike price on or before the expiration day. When you buy a put option, you are buying the right to sell the underlying asset at the strike price and or before the expiration date. Let's get more into it. Let's see the call option. When you buy a call option, you are buying the right, but remember, as you are the buyer, you don't have the obligation, so you are buying the right to buy 100 shares of the underlying stock at the strike price on or before the expiration date. Let's see how it looks like. This is a typical call option. FB 335 call for June 21. This is a Facebook call, $335, 4th of June 2021. So in this example, if you buy this option contract, you have the right to buy, because it's a call, 100 shares of Facebook, FB, at $335, which is the strike price, before the expiration date, that is the 4th of June 2021. Now, as one option contract controls 100 shares, if you buy two contracts, you can buy 200 shares of the stock at the strike price. This hypothetical call option might cost you, let's say, $7.2. This means you have to pay $720 to buy this contract, as you have to multiply by 100 shares that you are going to buy. Remember that the closer the strike price is to the current price, the more expensive the option is, as it has more value because you have the right to buy the stock at a lower price. Okay? Let's see if it's more clear looking at an example. Let's see this call option example. Let's say that you like Facebook. At the moment, its price is $330. So you made your analysis and you think that Facebook price will increase in the next, let's say, 3 months. You decide to buy a Facebook call expiring in 90 days with a strike price of $330. These call options, let's say that costs you $20, so you invest $2,000, because you have to remember that you have to multiply this value by 100 shares. Let's go on with this example. Let's see what happened when Facebook was trading at $330, but now, for example, Facebook dropped to zero. In this case, your option expires worthless, and you simply lose all the amount of money you invested in the option. So the option value is $2,000, which was the investment you made buying this option. If Facebook remained at $330, which is your strike price, your option expires worthless again. And also in this case, you lose $2,000, so the entire amount of money you paid for the option. But what happens if Facebook goes to $335, so it increments by $5? Your option values is $25 and you gave $500, so it's just 25% more. And if Facebook goes to $340, which is $10 increment, your option values $30, so you gain $1,000, and this is a 50% increment. So let's recap. Generally speaking, when on the expiration day the stock price is at or below your strike price, the option is going to expire worthless, as there is no advantage and no value in being able to buy the stock with the option when it's at or below the strike price. You understand? On the other hand, when the stock price is above your strike price, the option increases its value as you have the ability to buy this share at a lower price. The appreciation is $1 for each dollar increase in the stock above the strike price. Basically, in the call option example, when you buy the call option, you want the stock to increase as much as possible above your strike price, as you have the ability to buy the stock at a lower price, and the further it is, the more your option value is, and this is giving you more profit. So, if you have seen that the call option can give you a much more significant return relative to the money invested compared to directly buying the stock, but remember that on the other hand, you can lose all invested money if the stock doesn't move above your strike price. So you have to keep that in mind. Just to sum up, in the case of the call option, you want the stock price to go above your strike price. Only in that case you start making profit. If the stock price remain at or below the strike price, you start losing money. And what you can lose is the entire amount of money you paid for this option. Okay? Let's see now another very important point. As for selling a stock, you can also sell a call option. Selling option is, in my opinion, the best strategy to earn consistent money in the market. But to do it correctly, you need to learn exactly which strategies to use and how to use them in the right context and with the right management. This is the reason why I've created the Selling Option Cash Machine course. In that course, really go deeper into the only strategies that, in my opinion, can help you earn consistent money year by year. But that being said, consider that when you sell a call option, as long as the stock price is below the strike price you sold at the expiration date, the position will be profitable. Let's have a look at what I prepare here, and it's a graphic of selling a call option. Just to help you visualize, I'm gonna use my laser point and let's see this slide. So in this example, the stock price is at the moment at 100. So as you see, this is the current stock price. And you are going to sell a call option. So in this case, you are selling a call option with a strike price of 150. So this line here represents your strike price that you are selling. And 100, this line, is the price at which the stock is at the moment. As you can see, as long as the stock price is below the call strike price at the expiration day, the position will be profitable. The only way to lose money is if the stock price rises substantially and goes above your strike price that you sold. Only in this case you start losing money, and the loss potential on a short call position is theoretically unlimited, as the stock price has no limits in the upside movement. This is very important to understand, that whenever you sell a call option like this example, if you have an adequate safety margin, the stock may goes down and you can earn money, can stay sideways and you earn money, and it can also goes above and start increasing its value, but in starting earning money. The important point is that in this case the stock price must be below the strike price that you sold. Okay, I think this is really helpful to show you how it really works. Now let's continue and see the other different type of option. We had the call option, we have just learned this, but we also have put option. When you buy a put option, this time you are buying the right, but not the obligation, again because you are the buyer, to sell 100 shares of the underlying stock at the strike price on or before the expiration day. So a put option looks like this: FB 335 put for June 21. Again, like the before, in this example, if you buy this option contract, you have the right to sell, because it's a put this time, 100 shares of Facebook FB at $335, which is the strike price, before the expiration date, which is the 4th of June 2021. As one option contract controls 100 shares, if you buy two contracts, again you can sell 200 shares of the stock at the strike price. And as we said before, let's say that this option might cost you $7.2. You have to remember that you have to multiply this value by 100. So you have to pay $720 to buy this put option. And this time, the closer the strike price is to the current price, the more expensive the option is, as it has more value because you have the right to sell the stock at a higher price. So let's see an example. This time, this is a put option example. let's say that you like Facebook again. Its price is $330, but this time after your analysis you think that Facebook will decrease in the next 3 months. So instead of buying a call, this time you buy a Facebook put option expiring in 90 days with a strike price of $330. The call option, let's say that costs $20, so you invest $2,000 as you have to multiply the $20 by 100 shares for each contract that you are buying. Let's see now what can happen to Facebook when it was at 330, but now, for example, Facebook this time goes to 350 and your option expired worthless, so you lose $2,000. If Facebook remain at $330, your option expired again worthless and you lose $2,000, the entire amount of money. But this time if Facebook dropped to $325, so it's just $5 below the strike price that you sold, your option values $25 and you gain $500 in total, which is a 25% increment. And if Facebook dropped to $320, your option value is $30. You gain $1,000, which is a 50% increment on your option. Generally speaking, when on the expiration day, the stock price is at or above your strike price, the option is going to expire worthless, as there is no advantage and no value in being able to sell the stock with the option when it is at or above the strike price. On the other hand, when the stock price is below your strike price, the option increases its value, as you have the ability to sell the share at a higher price. The appreciation is $1 for each dollar increase in the stock above the strike price. So basically, when you buy a put option, you want the stock to drop as much as possible below your strike price, as you have the ability to sell the stock at a higher price, and the further it is, the more your option value is, giving you more profit. So if you have seen that the put option can give you a much more significant return relative to the money invested compared to directly buying the stock, on the other hand, you can lose all your invested money if the stock doesn't move below your strike price, and you have to keep that in mind. As seen before, of course, you can also sell a put option. And again, selling option is the best strategy to earn consistent money in the market, but to do it correctly, you need to learn exactly which strategies to use, how to use them in the right context and with the right money management. But that being said, consider that when you sell a put option, this time, as long as the stock price is above the strike price you sold at the expiration day, the position will be profitable. But if the stock price drops substantially, the potential loss may be significant. Don't forget this. And now, as done before, let's see a graphic of selling a put option. And again, let me help myself with a laser pointer. This time, the stock price is trading at 150 and we decide to sell a put option with a strike price of 100. Now, as long as the stock price is above the put strike price at the expiration date, the position will be profitable. If the stock price falls substantially, the loss potential on a short call position is potentially significant, but this time is limited to when the stock price reaches the value of 0 in case of bankruptcy. So it's different in the case of the call option, where we have no limits and the potential loss is unlimited. This time, as the stock price may only goes to 0, the loss that you are getting in this case is significant but still limited. So to sum up, in this case, if you're selling a put option with a strike price of 100 and at the moment the stock price is trading at 150, if the stock price goes up or it stays sideways, or even if it goes down but still above the 100 strike price that you sold, you are still winning. You are earning money. The only case where you start losing money is when the stock price goes below the strike price that you sold. Okay? I hope this is very clear and help you understand how it really works. Now, we are approaching the end of this course. As you have seen, trading options has its benefits over trading stocks, but as you've learned also, there are some potential risks that must be considered. With this crash course, I wanted to give you just a basic knowledge of how options work and make you understand that they can easily change the way you are trading. As options are so flexible, you can use them creating complex strategies that can help you in every market conditions. And this way you can earn money even when the stock moves up, down or stays stable. So in my opinion, options are the only instruments that let you trade with odds on your side, having so the best chance to win almost every trade. So, if you are really serious on learning the only strategies that really work and can make you earn an easily 20 to 50% per year with low and controlled risk, you definitely have to check out my course where I teach you exactly the strategy I use to make consistent money from the market with a 90-95% of winning trades. Those are the ones that I've been trading for years that make me profitable all year round. Invest in yourself and learn the skill that you can use forever. This is my only advice. So if you are interested, you can have a look on my website smartpeoplefinance.com, or you can go on my YouTube channel Smart People Finance and check out the selling option, the cash machine course. I hope you enjoyed this crash course, and what's more important, let's keep in touch. Subscribe to my newsletter and YouTube channel so to be informed as new interesting posts on trading, investing, real estate, making money online and personal finance come out. I wish you a wonderful and joyful day. See you soon, your Max. Thank you for listening. See you there. Bye.